being a guest in our house.
Good evening, good evening, guys. How are you all this morning, this afternoon, this evening? We're guys. Welcome in. What a week it's been. Absolutely phenomenal week, hasn't it? Beautiful. Well, Syriza sweeps to victory in Greece. And no, been on the cards, actually. To be honest, guys, been on the cards for some time, hasn't it? And we've been certainly selling this euro for certainly the back end of December. We got reinvigorated to go sell side only this euro, and boy oh boy has that paid off beautifully. We've always been talking about QE. In fact, you know what? Since we started actually in this room, I know there's a lot of people in just for the visit tonight. So and some of the stuff will be in general terms then. But since we started this room back in April, we went sell side only. The euro, and you can see that we've traded from 140. We traded from the 140 level. Currently now trading at 110. That's a bigger move than the Swiss National Bank surprise move, wasn't it? So, I mean, but we've been selling consistently the euro all the way through that process, guys. And this is one of the things you'll really start getting to grips with is the fundamental backdrop of your trading. You're really going to start getting to grips with what's happening in the marketplace, how to take advantage of that, how to really start engaging with the market, start talking about it in terms of the way that institutional dealers would be talking about it. You know, we're not interested in the retail space. We're not interested in the space in as much as people wanting to talk about moving average crossovers. It's not the game that we're in. That's not what we're here about. We've managed to get to the extent of a Bollinger Band. Bull crap, basically. What does that mean? It means nothing. Absolutely nothing. It's got nothing to do with trading, and it's basically just things to fill up MT4 platforms with all these wonderful indicators that you may already have on your screens. And I've seen some traders with some horrific screenshots of 20 different indicators, and they need 19 of them to confirm an actual trade entry. Unbelievable. And by the time they actually get the trade entry, it's time to go the opposite direction. Those are the kind of indicators that actually can be useful, because as soon as you get a sell trigger, you just buy the thing. As soon as you get a buy trigger, you just sell it, because you're probably at some kind of mad extremity that it's only the numpties that are selling, and that's the guys that we want to be buying against. And that's really where we want to get all the traders in this room up to, is being able to buy where the numpties are selling. And basically that's where we're really trying to get everybody at that point to be institutionalized in as much as not in the way that you probably think, but institutionalized in the way that they're considering, in the way that they're terming the market. Because it's so important you get these fundamentals right. People discount the fundamentals because it results in the price action. You can see it in the price action, but you see it in the price action after the event, guys. That's the problem. We can all see it in price action after it's happened. But we've been sell side the euro from 140. Okay, we haven't had to wait. If you were on something crazy like a monthly chart, and you see maybe 4, 5, or 6 down bars, and you say, okay, well, it's now in a downtrend, I'm going to sell. Well, probably at that stage, your moving average crossovers crossed over, and you're now currently at the price of 110. And at that price, we're looking then and saying, okay, we're going to start looking at buy opportunities off bottom edges here. Okay, so fundamentals actually gets you sell side before the price action then tells you that it's going to be sell side. Fundamentals say to us, sell side the euro, price action tells us when. Okay, price action gives us the location, order flow gives us the location. All these other little aspects give us the location, but we need to have a basic idea of this. We need to know, are we going to be selling the euro today? Because a lot of people say, don't have an opinion, come on, guys, seriously. Do you think that institutional traders in Bundesbank, or the guys at Deutsche Bank, or the guys at Citigroup, or the guys at the Fed, or the Bank of England, when they sit down at their desk, they don't actually have an opinion? That they don't know what they're going to be doing today? It's just ridiculous to consider that that's the case. Now, what I do say, as a little balancing act on this one, is don't marry your opinion. In other words, you don't have, as a retail trader in most cases, you don't have access to what the big boys are going to do. Obviously, the big boys know exactly what they're going to do, so therefore they can trade accordingly. they have a very, very strong understanding of what the other big boys are going to do. Why? Because they're probably on the phone to some of them. They're probably talking to them. They're probably in a conversation saying, what are you guys doing here? Are you guys playing this? Are you guys walking away? And some of them might decide to take on the SNB, or some of them might want to take on the Russians or whatever. So there's always these dialogues going on in the marketplace, and never think that there isn't. But what that means for you as a retail trader is you'll have an opinion, but don't marry it. In other words, don't keep buying as the market keeps dropping and thinking, well, my opinion is going to be right, the market's wrong, because obviously that's not going to be the case. Now, just think about this chart that we've got up on the screen at the moment here, guys. Very simple chart. Very simple chart. It's the euro. And it's on a daily chart, okay? And as I said, we've been sell side all the way down this market. The up arrows are actually periods of time when we know that through the process of structured note writing, we look at structured notes. It's going to be part of the course coming up here. Through that process, we would expect to see a little bit of a balance period developing. And what we're looking here is at a period where we know that the big boys are testing a bottom edge just to see what's there at the moment, just thinking about what the bottom edge is holding. So these little up arrows that you see on the euro is when we would be more into a rotational market, and this is obviously over a course of maybe a week, 2 weeks, 3 weeks, 4 weeks. And then we look at opportunities once the big boys have decided that they don't want to go any higher with regard to the contra buying, that they re-engage sell side only, and boom, off we go. And we've been sell side only now for quite some time now. In that respect, we also brought out this thing called the PFM, the Predatory Fund Matrix. Now, it simply sounds grand, but it's simply just an assortment of ideas as to where the predatory fund guys, where the aggressive bank traders are positioning themselves with regard to the overall landscape. Now, we didn't start this, many moons ago. We just started this actually last week. In fact, I was asking Kim what day we started it, and the first day that we actually talked about it was the 14th, and I gave Kim the initial readings on the 14th. Now, if we look at it from the 14th here, this is the euro on a 60-minute chart, and you can see that from the 14th here, this was the very first sell trade that we had here. Now you look at this, and a lot of people will look at this market and say, okay, we've got a bottom edge, let's start fading this. Now, how many of these bottom edge trades actually led to a profit? If you actually took every single price point from the beginning of this chart here, around about 121 approximately, and down to the very bottom here at around about 117.60. There's only one single bottom edge on this chart, isn't there? And that's 117.60 approximately. So every single price that was on that process there, every single one of those trades, if you were trying to fade, would have been losing trades if you held all the way down to this bottom edge. So in other words, if you try to fade the bottom edge, and there's obviously been approximately 400 odd pips there, so you've got a 0 out of 400 success rate so far. Every single one of those sell trades, however, would actually have been in profit. So you'd have had a 400 out of 400. And that's what we're trying to get into people's heads when we talk about the fundamentals. When we start talking about that the euro is sell side only, the high probability, and obviously it's going to be a case of then finding those opportunities as far as the price action, the order flow, and the levels and the liquidity are concerned, to see how do we get involved in a deal. Now, the trade actually was, the trade on this one in this case, this was the 14th, this was the day we first brought in the predatory fund. We brought it into the room on the 15th or the 16th. This was the first day that I introduced it to Kim and Stephen in the room, and the first trade was actually this one just north of 118 here. And it was after we had seen a nice bit of finished business, and we were actually trading. When we've got finished business at a top edge and a bottom edge, we always look for a trade called basically an inside-out trade. And therefore, it made perfect sense to go sell side here, slightly north of 118, and back into balance. And you can see ultimately, very simply what happened after that. It's been sell side only. We've got an awful lot of drawings on this particular chart for several reasons. Now, one of the things you'll start really understanding this concept of what finished business looks like against what unfinished business looks like. Because unfinished business will come back to finish it off. The trade will come back to that price to finish it off. It'll generally trade away from finished business for the time being. And there's several ways to define finished business. Stedermeyer, in his books on profile, for example, suggests obviously this concept of minus development. If anybody's a Stedermeyer aficionado, then a lot of good stuff in Stedermeyer. But Stedermeyer himself goes on to comment, just for example, that profile on its own doesn't make a profit. You know, as a general rule, it doesn't make a profit, and that's an incredible statement by somebody that obviously invented profile back in the day when it was Wall Street's hidden secret, effectively, wasn't it? And this is actually coming to its core. It's not one thing, guys. The market's not about one thing or one aspect only. It's about a combination of loads of different pieces of a jigsaw. And it's your ability as a trader to take those pieces of a jigsaw, put them all together, and make some kind of sense of it. Now, that comes from reading the market. It comes from tape reading, it comes from volume reading, it comes from price action reading, it comes from fundamental reading, it comes from sentiment reading, it comes from all these various aspects. And when you can actually read all of them, you can start making some kind of sense of what the market's telling you. And if you can make sense of what the market's telling you, you can then start projecting that sense onto the right hand edge of your screen and start making sense of where trades could or could not possibly be. There have been a couple of trades already this morning or this evening, wherever you are, but we went sell side anyway. And this was when we brought the matrix into the room. We were going sell side euro, sell side only, and we were looking for what we determine as higher liquidity. And a lot of people, as I said, would see this as a great buying opportunity. And look at these guys up here. Now, everybody, probably every single person in this room knows what happened right there. It's simply called trapped buyers, isn't it? It's all these guys that see the bottom edge is put in and they think to themselves, okay, that bottom edge is beautiful, absolute cracking. I want to be buy side, and I'm a bit late onto this because I didn't know that was going to happen. So I'm just going to buy as soon as we break out this bottom here, because this is going to go all the way up to maybe 118s from 116 and a halves. And they're thinking 150 pips. Yep, well, that makes sense because 116 and a half down to maybe 114.40s. You know, it's around about, you know, possibly I could get an even money trade here, but very high probability that I'm going to get at least a rotation. Well, we go sell side. We wouldn't do anything but go sell side here. Why? Because it's a grab into higher liquidity. We participate in the pain that people feel when it gets a little grab of liquidity top edge, a stop run. We never ever are involved in a stop. We're never on the wrong side of a stop run because we always know where to see these stop runs. If we're on the wrong side of a trade, it's certainly never at a stop run location because we haven't got any kind of setup type policy on how to deal inside of those locations, because that's not an institutional area to either go long or short in. So we don't have a particular setup that's going to cause us ever to be a victim of a stop run. Okay, so we're always looking for those opportunities that stop runs exist that we can participate in as far as getting sell side action. And this is one of them. So we would go sell side here. We know that we're sell side the euro dollar according to our overall matrix. This little liquidity grab. Now the matrix, you might think, just so that people, for completeness, don't go away and start putting on deals and say, oh, the matrix was wrong. The matrix actually, we've now been going, as I said, Kim said, 15th through to the 25th. So 8 days approximately. Do you know, in 8 days, we've had 8 monster days. We had 400 odd pips the very first day. We had 200 pips the next day, and this is on one contract, on one market only. We've been buy side the gold for a couple of monster moves on it. We've been sell side the euro for a few. We've actually been buy side the yen, which was quite controversial at the time, and we managed to pick up some absolutely cracking trades. And if you just paired one with another, sometimes you have to wait around about 24 hours before the trade reveals itself. But that's part and parcel of this particular little course is that you know where to spot the trades. You know where you're going to start looking, because there's only certain locations on this chart that institutions can deal. There's only certain places that make sense. This guy's here is one of them. Institutions can deal here because they know there's an awful lot of guys in the wrong side of the trade here. So if they want some sell side action, they can go sell side off a location like that without having an awful lot of slippage. And you'll find that volumes are pretty good on those kind of trades. So we're sell side only anyway, and we got a monster trade there. We actually take part in the QE. We're not a victim of the QE process. And we actually ended up with a cracking little move off the top edge. It was a beautiful little trade. So breaking this down into the 5-minute, we are currently sell side the euro again this morning. The trade is the little pink box here on the tap back. We went sell side just here at 111.62, currently printing at 42, so we're up 20 pips on this one. And the other trade that we have is a little trade we took, actually interestingly, on dollar yen. Now I apologise if I'm going to be repeating anything that anybody else says, because we each cover our markets from our own perspective, and sometimes that means that we'll say things that somebody's already said, or we'll possibly even contradict each other, because the one thing that we're not afraid of in this room is controversy. We're quite happy if we've got a disagreement, we'll bring that disagreement into the room, because at the end of the day, it's a prop desk. It's a prop desk. Now, we went buy side the dollar yen here, and we actually managed to pick up a pretty nice little 10-tick trade, but very, very strong selling. As soon as we went above this liquidity here, very strong selling comes in, and it's a rotational look about this particular market. Obviously, we've got an overnight Japanese session kicking in here, and that's going to start driving this. So we picked up 10 pips on it, and we took a +1 scratch trade on the other. We're sell side the euro, and the big news for the week, guys. So I'm going to split this up into 2 sessions. I'm going to have a quick look at the data, a quick look at the overall macro picture of the marketplace that we're going to be existing in this week, and I'm going to do a little class on price action, because a lot of the briefing, the evening briefings, because unfortunately Monday's a bit of a dead day for us, to be perfectly honest. There's not an awful lot happening as far as data to play into. But we've got a couple of angles on it. I'm going to start looking at that. It's all about building scenarios. That's probably the best way to kind of put this. There isn't a right and a wrong scenario. There's just a scenario, and that scenario is representative of a series of events taking place. It incorporates the overall directional bias of a market. It incorporates the price action. It incorporates the future sentiment that we're going to be dealing with. Now, sentiment is a future event. It's not a past event. The past event is the actuals. The past event is the actuals. It's the dealing of what happened to the sentiment, what we're using as sentiment projected into the future, and saying, how do we take that sentiment and make sense of it with regard to what's happening in price action, what's happening in order flow, what's happening in volume. And it's from that we start developing some scenarios that make some kind of sense to us. Now, through the scenario planning process, we've done several classes on that, and the guys have sat through 2 or 3 hours of me going on about specific scenarios. And the thing about this room, guys, is, and as I said, I know a lot of the people in the room tonight are not room members. So, I'm spending a little bit of time just going through this. So, but a lot of the time, the whole day is an educational class, by the way, guys. It's not about calling trades. At the end of the day, we need to teach you how to call trades. It's not about me calling, or Stephen calling, or Mark calling. My contract with the firm forbids me to call trades live, but we can pinpoint where we will be dealing, and then it's up to you, obviously, at the time to make up your own mind. Mark and Stephen quite happy to put into the room exactly what they're doing, exactly when they're doing it. But I generally will be more institutional in as much as we will have specific areas and specific trades in mind. And then if you look to your charts, and we teach you how to find the opportunities to start looking at these trades and start dealing, and that's the idea, is we're not wanting you to become clones of us. We want you to develop your own style, because we don't know what size of account you've got. We don't know how many hours you're going to spend at the markets. We don't know how many bullets you've got to fire off at the markets. We know nothing about you at this stage. And therefore, we can only give you a series of tools, and you can adapt and bend and shake them to make sense to your trading and your trading only. And I think that is probably what's important. So a lot of the days we're doing classroom sessions at 30 minutes on price action here, and it's always something that's relevant on the current charts. It's not going back into 5 years worth of rubbish. It's about something that's just happened, a question somebody's had, and says, could you go through the price action that just took place on the euro yen, so that we can actually get an idea of that? Can you go through this? Can you go through that? Blah, 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 blah. And then we'll cover that as a classroom session. So the evening briefings, we normally look at some of the data the following day. And unfortunately, there isn't that much for tomorrow. And therefore, what we're going to be looking at is a slightly bigger kind of global perspective of how this market could develop and pan out. Now, I'm just going to do that first, and then we'll touch on some of the tape reading skills that you can get simply by not having access to the tape, simply by looking at price action and coming up with the ability to read. This is going to form a core of our training this week for the guys that are in the room. So for the guys that are room members, the kind of core training this week is going to be centered around the microstructure tape reading skills, using volume, using levels, using trend lines, using value levels, using support and resistance to find those kind of opportunities. And we're going to start that little class off tonight, just to give people an idea of what it is we do. And but first of all, let's take a look at the week coming up. What have we just had? Now we've had. Now I'm sure Mark and Jason probably have already asked you what the market's going to be talking about. Now, you know, there isn't a right and a wrong answer to any of these questions, by the way, guys. It's just your opinion of it. You know, because some guys are going to be talking about one thing, other guys, the bond guys are going to be talking about something potentially different from the guys that are in the spot desks. The spot desks are going to be talking about something different from the guys from the macro hedge funds, and so on and so forth. So, you know, it's only your opinion, it's only your view. Now, there's a lot of things. Last week we had good GDP numbers out of China, so we had really pretty positive numbers there. But in the general grand scheme of things, what is Chinese GDP looking like? You know, because you want to be making sure that you've got an idea of what the big picture is actually telling us. So on that basis, guys, what is the bigger picture of the Chinese GDP? Anybody? Since, let's give you an example, from quarter 1 2012, what's been the GDP position? Chinese GDP since quarter 2, probably quarter 1 2012. It's been slowing, hasn't it? It's generally been slowing, so you know, you guys have already got a good grasp of this bigger picture. So that gives us a couple of ideas. What is, out of the major currencies, what is the currency that's most linked to the Chinese markets? The dollar is one of those markets that you want to be paying attention to Chinese data on, and you know we've been sell side for, you know, quite some time, and again, the guys that are regulars in the room will confirm this. We've been sell side the Aussie dollar for quite some time, and just a short while ago, we actually went buy side for a few days. We managed to get a few big boys involved with us to go buy side the Aussie and see if we could get any kind of movement at the top edges. And then just most recently, we decided ahead of, not post, but ahead of the Canadian information, to go sell side the Aussie. Now, on the basis that we went sell side the Aussie ahead of the Canadian central bank's announcement, then we obviously managed to take advantage of what turned out to be an absolute belter of a move, because here's the Aussie dollar right here, and if we take a look at this one. We had been buy side this one. I mean, I'm just being clear about this, but we'd made a fortune on the buy side, and then most recently, we managed to start getting some sell side action into this. Just, in fact, it was even longer ago than that. Let me just zoom in a little bit. We started going sell side action off of this massive blue zone here. And we actually had a discussion in the room. One of the other traders, Stephen, comes into the room and asks the question, because I came into the room and says, right, we're changing our tack on this. We're changing our tack. We were buy side. We were buying off the bottom edges here, guys. We were absolutely killing it as far as buy side action. We were buying all these bottom edges. And then at this stage here on the On the 19th or the 20th, we went sell side only the Oz. Let's dump our Oz. Let's get out of this trade. Let's go sell side only the Oz. 82.30s, and we were hammering this one as fast as we could, as hard as we could. 82.30s. Guys, it's now trading at 78.70s. It's 500 pips nearly down to the downside, and all you had to do was keep finding this higher liquidity level to get some sell side action for a beautiful little pop on this one. We actually took quite a sizable gamma scalping trade on this one. We took a straddle trade on it, and the idea here was that the Oz might well follow the Canadians with an interest rate drop, but we'll have a look at that one in due course. But all we're looking for here is some movement. So we've started gamma scalping this one, and we're going to see if we can actually crank out a nice little profit on it. So at the moment, it's been sell side only the Aussie, and we've absolutely killed this one. It's bearish and offered at the moment, and we're looking at these higher liquidity grabs. It's one of our top targets as far as our sell side. So the top targets, the race to the bottom has been between the euro and the yen, and then the Aussies joined them. And I've been, the guys in the room will know that I was very, very aggressively selling the Aussie. I was shouting at anybody. In fact, me and Stephen had many a heated discussion, I think, in the room, because he was trying to buy bottom edge and I was selling top edges. And we were both making some money, but obviously being on the institutional side, we were making a hell of a lot more because we were able to sell and hold, which is fine, obviously, on the bigger picture. The guys that were buying at bottom edge had to be really aggressive. Stephen's really aggressive trader, buying the bottom edge, trying to get that little rotation back up into institutional sell side. And then we were smashing it and selling it and holding for that lower liquidity, and we kept getting it. Well, just recently we went back into sell side action. We've been sell side only the Aussie, and you can see what's happened, guys. If we told you back here, sell side only, can you see how can you see how difficult it would have been to have made some money? Because you're never trying to buy this. You're never going to be trying to buy anywhere in this period. The idea here is to try and sell as much as you can at the very, very best prices, because value is dropping on a consistent basis. And we need to know where prices are trading at a premium to value, because that is what institutions are interested in. If prices are trading at premium to value, then the key aspect here for your trading is you want to be dealing at those levels. Okay, so when we see value, when we see prices coming off this blue zone here, and by the way, the blue zones, all these levels get projected onto your charts if you have an MT4 platform. These levels are actually on your charts, and the blue zones are like gold dust. So this level right here, sell side only, comes down, higher liquidity grab. There's a beautiful little acceptance at the bottom edge here. So this level here is trading at a premium to value, and therefore we want to be selling it. We want to be finding a way into some sell side action here, and there's a beautiful little bit of price action that develops in here that gets you some sell side, and then there's a little bit of noise, a little bit of nonsense going on in this area here. A lower acceptance, it was a beautiful squeeze. The compass room squeezers were out in force for that sell side action there in the late European, late London session. It was actually quite, what time is that? Around about 7 o'clock London time. So we were in this squeeze, beautiful pop for the trade to the downside. More sell side action, more higher liquidity sell side action, more sell side action, more sell side action. It's just been sell side action, and every single one of those trades is a monster trade. Because you can actually find trades that are only running maybe 5 to 10 ticks, 10 tick stops. You don't have to be running 150 tick stops, even if you're trading on the bigger institutional framework, because when you start drilling down into the smaller time frames, we simply need to see, as far as you guys in the room, need to see these high volume nodes that are developing inside of the smaller time frames. You can see it on a footprint chart, you can see it on your 1 minute charts, you can see it on your 5 minute charts. You just need to see that high volume node developing. You know what side of the trade you want to be on. You can see that price action has done certain things at certain prices, and you've simply says, I can lean against that volume, because guess what? If that volume gets taken out, then prices will have to go higher to close off the buyers that have managed to establish themselves outside of that volume. Okay, so very, very important that you get those kind of concepts clear in your head as to how and where you want to deal and the kind of things you want to start looking for. So it's been sell side only, the Aussie, from the blue zone here. And since we changed our tact on this one, it's been an absolute goldmine. And we all know that the link between the Aussie dollar and gold is quite strong. And here's the other thing. I would assume most of you, obviously, if you're trading the Aussie, you shouldn't be trading without gold in front of you, should you? You really shouldn't be trading at all without gold in front of you. And equally, if you're trading the CAD, what market should you have in front of you? What other market should you have in front of you if you're trading the CAD? If you're trading the old Looney Tune oil, you should be watching oil at all times, shouldn't you? You should absolutely have oil charts in front of you because it gives you some kind of correlation. It gives you some kind of idea. If you're trading the S&P, what market should you have in front of you? You should have, a yen-based market, Aussie yen, dollar yen. You should be looking at one of the yen-based markets so that you get some kind of idea about what you're wanting to deal, how you're wanting to deal, where you're wanting to position yourself. And sometimes the correlation breaks down. But here's the point: the guys in the room don't trade it blindly. They don't just say, "Oh, it's dropping, so I'm going to go sell side." What they can say is, that's dropping, I want to go sell side, and therefore I've got a really good reason to start looking at some of these other ideas, some of these other intermarket analysis type concepts, because I want to be seeing how this market can develop. So knowledge of that side of it is going to be useful as you go forward with your trading career. So what else have we had last week? Well, we started the earnings season, didn't we? The Nikkei 20, absolutely as well. And the Nikkei, you want to be watching how that index has been trading. You want to be watching how it's closing. You want to be watching where the levels are on that as well, because projecting those levels into the quieter S&P. If you've got a 24-hour continuous contract on the S&P or the SPX, then you want to know the key levels on the Nikkei as well, so that you can project those levels onto your SPX and get some ideas according to that. You also want to have your market breadth information if you're trading something like the S&P. And if you're trading the S&P, the other market I strongly recommend that you have in front of you is certainly one of the USTs, the 10s, the 30s, ideal. The 10s or the 30s, preferably both, because when you're, when you come into the room, if you do decide to come into the room going forward, one of the things we're going to be looking at, one of the things we've taken a lot of time to concentrate on is bull steepeners, bear steepeners, bull flatteners, bear flatteners. We're going to be looking at an opportunity to leg into, for example, an iron condor on a bull steepener or a bear flattener type situation, and leg into them so that you go buy side or sell side the 10s and go buy side or sell side on the opposite side on a leg in type process at the top edge of the 30s, so that you're getting advantage. You're taking advantage actually of not one market but two markets that should be, in relation to their overall positioning, should actually be developing into some kind of mean reversion type process. And that's one of the things we're going to be teaching in the option course. We're going to be that's going to be part of the classroom over the next few weeks, and that's going to be really exciting, because it means for guys who don't have all day and all night to actually sit there and trade, it means that there's going to be opportunities to get involved in the options on a delta neutral situation. In other words, it doesn't matter on the overall direction of the market. If the market is going higher or lower, you're not going to make or lose any money. The idea here is actually to be legging into certain positions that, on the basis of what is happening in the market, bull flattening, bull steepening, etc., that you're able to take advantage of trading the 30-year against the 10-year. In other words, the spread between those two markets, and but legging into the process. As a good example, we legged into a process on the Swissy after the SNB announcement. It was during the very, very high volatility that was developing after that SNB announcement, and absolutely killed the market. But I won't go into facts and figures at the moment, but a beautiful, beautiful, beautiful trade it was. Anyway, that sell off the 65s there, guys, is doing all right. We're trading down at 25 now, 40 pips on that. That's okay. I don't know if Jason or if Jason was looking at it sell side, but that's number one on our. That's number one on our predatory matrix. I think Kim's already put that one up, has she? Way up, she's got it bearish and offered the euro, bullish and bid the USD. So there it is there, and it's been sell side. You just had to wait for that opportunity, unfortunately, for the guys that don't know what we're talking about, or indeed hadn't obviously had a chance to see that. But we've had that matrix actually. That was pretty much in line with Friday's data as well, and we would have been looking for that sell opportunity regardless of how you would be looking to deal this. Now, there's going to be a couple of problems here, but there's a question actually there from Fred. There's a couple of problems with teaching institutional trading to retail space, guys, because one of the key problems is we don't have a price. We have a price in mind, but the deal is that we're going to be selling at that price or better. In other words, or higher. So as price goes higher, we'll keep selling into it. We'll build a position over a range of prices. Sometimes that range can be 20 pips deep. Sometimes it can be 150 pips deep, and it depends. And so we've got to adapt our overall ideas here to trade with a lot of the guys that are one-lot traders here. So on that basis, you've got to be mindful very much of the fact that we're going to try and adapt some of those little ideas so that you guys can actually use them, because there's no point in us saying, okay, we're going to be selling into this particular location and then leave you sitting there saying, okay, well, that location's 150 pips deep. Whippy fecking do. How am I supposed to deal? And that's going to be the question that you've got to try and ask yourself. Well, that's what we try and avoid. We don't give you 150 pip deep channel areas. We have ideas, we have locations, and then we zoom in. That's why a lot of the times we'll concentrate on the 5-minute charts, okay? So on that basis, guys, it's going to be a case very simply of grasping some of the core concepts of how the institutions are dealing, where they're going to be dealing from, and then using that information to then look for a location on a 1-minute, a 5-minute, a footprint chart. There's a guy in the room that has done presentations. In fact, one of the webinars, Peter, who uses the footprints and looks for volume inside those footprint charts to try and get some deal off. I don't know if anybody was sell side euro yen. Well done, guys. There's another 100 pips in the back pocket there, guys. A nice little liquidity grab early doors, and it's been sell side only. It's our number one pick as well. It's a euro sell side, yen buy side, and this is exactly the point of this room, guys. Everybody would have this. Everybody would have this already, because we already had that from Friday. And it's sell side, the euro, and that's been our number one there right from the get-go. Right from the get-go. Now, on that basis, we only update it once a day, because the institutions, here's another key point here, the institutions don't change their mind as far as the big picture, the global picture, the macro picture. They don't change their mind in the course of a day, or 2 days, or 3 days, or 4 days, or 5 days, or 6 days. They have a macro picture that changes over the course of 6 months. Okay, that gives you the good thing about that is that gives you plenty of opportunities then on a day time frame to actually trade aggressively, but it also gives you huge opportunities on the longer time frame to then position yourself properly and appropriately in the right direction of the market. So we know that this euro is sell side only. It doesn't mean we can't buy it, by the way. It does not mean we can't buy it. There's going to be plenty of opportunities, but what it does mean is that we know when we can buy it. We know when we can buy it, and we know what to expect from any long positions. We know what to expect from any trade that comes from those long positions. Alrighty, so what else have we had this week? What is key? What are people going to be dealing with in the States here, guys? Yeah, I don't know if, as I said, Mark or Jason have already went over this. So what else are we going to be dealing with? What are the black swans or the big events that people are dealing with at the present moment? The FOMC? Well, seriously, FOMC? Seriously, the FOMC? Actually, probably right. Yeah, they'll be dealing with the FOMC, just winding up. But yeah, the FOMC is important, but I think the FOMC's it's dropped down the list of important events this week. Why? Because it pretty much is a non-event, isn't it? Well, we say pretty much a non-event. Hot dogs at $43. You should see the price of the hot dogs in my local blooming cinema. Holy moly! Took the girls to the cinema last night to watch American Sniper, and I nearly passed out. You know, I'm going to need a good trade in this euro dollar today just to cover the cost. Unbelievable. Anyway, so the idea is the FOMC, I think, is pretty much a gimmick. Now, what we're trying to do here is understand and clear up some black swan type events. Now, you might think, how often do these black swan events come into play? Well, just think about it. Think about the kind of events that we've had in the last couple of months here. We had the surprise QE, extra QE program from the Japanese. Okay, we had that just last year, the end of last year. So we had a surprise extra QE program. Alrighty. We had, what else did we have? We had the SNB, obviously. We had the SNB that just decided to come out and blow all these people out the water, and so that was another surprise event. So we've also had the Canadian rate drop, which was a surprise event. Well, it wasn't actually a surprise because we were sell side only the Canadian dollar prior to that, believe it or not. And you can ask any guys in the room, we were actually really heavy sell side the Canadian dollar before the Canadian rate drop. So we made an absolute fortune on it, an absolute fortune. So on that basis, we absolutely killed this one as far as that rate drop. So we've had three real key events, which were black swan type events, and that's why scenario planning is so important, because it really does give you an opportunity to start looking at the possibilities of certain things going on, which really in a lot of cases you're not really going to be looking for any other time. And when we come to these briefing sessions, we're really coming to these briefing sessions from the point of view, very simply, of coming to the briefings with a view of looking for these kind of opportunities. There might well be contra type opportunities, but looking for the kind of key cornerstone events that might just happen that gives you a huge heads up that all of a sudden you go, I'm in that deal, I know where I'm going with this trade, and therefore I want to take advantage of a certain series of events happening. It's buy side dollar CAD, by the way, only, and that's a nice little trade there as well. It's been sell side the euro dollar, that's a nice trade. Sell side euro yen, which has turned out to be a nice trade. The pound's an interesting one. So what else? Okay, so we're just looking at some of the events here. So we had people mentioning Ukraine. Well, it kind of went off the front pages, hasn't it? But it shouldn't be off the front pages. It should be firmly on the front pages, because the ramifications of the whole Ukraine situation could be quite serious indeed, as you probably would expect. Now, not least the fact that obviously the suffering that's going on in Ukraine at the moment, but from a market's perspective, obviously the whole Russian involvement in this situation is getting out of control. And I think we're going to really see Merkel's resolve on something like this, because they've been talking about no extra sanctions. They've been talking about not wanting to push it too much, and in that respect, I would be very, very mindful. I'd be very, very mindful of looking at it and saying, okay, what is Merkel going to do with the Russians? Because the Germans, there's a very, very big economy attached to Germans, trade with Russia. Indeed, the world's trade with Russia. And obviously the Russians are saying, well, we can obviously source all our trade, from China, from elsewhere. They've signed some new trade agreements with China and saying, well, we don't need you, but you need us, sort of concept, blah, blah, blah. Anyway, it's going to be very interesting to see how Merkel deals with this whole situation as it develops. What else, guys? We've got housing starts, a lot better than expected, however. And that was on the numbers, but it was also quite discouraging on the overall trend. So we've got we've also got a huge number of earnings. We're now coming into earnings season. So for you guys that are trading S&P, we're in the middle of this earnings season. We've had 80% of the 20% so far reported have actually beaten estimates. So for you guys that are thinking the S&P is overcooked at the moment, just watch those earnings and be mindful of the fact that when we see earnings coming out like this, that we know that the S&P actually still has some potential for some upside action. And as I said, therefore, be mindful. Obviously, slightly disappointing because a lot of the S&P guys, a lot of the equity traders were hoping for this big cash injection coming into the markets, this free money injection, and that's obviously not happening in the S&P, finding a little bit of pressure up to the top side at times. But in overall terms, bullish market still in play, but that could well turn on a sixpence. So obviously, the final thing there that we're looking at is the Syriza, the Greek elections, the winning by the radical left, who have says through their various rhetoric, that they're not going to repay all the debt and all so on and so forth. I think that's just political gesturing. I think that the market would never allow them not to repay their debt. I think what's ultimately going to happen is obviously somewhere in between, that the rescheduling is probably on the table. And as a major event, there's a very, very situation about a very, very clear situation about this whole Greek situation just coming to some kind of quiet conclusion. They have to be seen to be doing something. They have to be able to. They have to be seen to be having some reward, some action of saying, yes, guys, beautiful. We've managed to do what we said we were going to do. The austerity is now at an end. We can now do this. We can now do that. We can now get involved in, some kind of expansion plans, etc. Now, there are some serious consequences from this whole election, and those serious consequences are, it sets up a model. If there are issues, if they do come out and say, we are not going to repay this debt, or we're only going to pay 50 pence in the pound or 50 cents in the dollar, then obviously there's a real problem here, because what is going to be the ECB reaction to that? They're going to say, no, not acceptable. Not acceptable. So what do they do? There's going to be there's some precedents, is what I'm saying. There's some precedents developing here that haven't been tested just yet for the Eurozone. And I think the Germans are sitting there saying, okay, well, do whatever we need to do here. But it is what it is. So where are we going to go next week? So next week we've got some real good data coming out. We've got GDP numbers. That's critical. We've got GDP on the Tuesday. In fact, we've got UK GDP. And there's actually a little change of tact on this one. I think actually the Aussie could well be in focus this week along with gold, because I think people will be buying gold on the safe trade this week, and I think it's going to be a mistake. I think actually, whilst we are bullish on gold at the moment, I think the buying of the gold could well be a mistake, and I'm going to be certainly looking at higher liquidity levels. And I'll be certainly looking to grab some sell-side action on that one. I'm going to be just checking that one out. I'm not going to be aggressive with it, but I'm going to be watching it carefully. I'm looking at the beginning of the week with a kind of oil pressured market. Now, we've seen oil coming off already this morning, so that's no real surprise. But I'm looking at the Canadian dollar being under pressure. I'm looking at gold being under pressure, and I'm looking at the Aussie being under pressure, amongst obviously our main market, which is going to be the euro sell side. I don't think the interesting buy for this week is going to be the pound. I think the pound could well be one of those surprise markets. I'm looking at a long-sided pound against some of these weaker opportunities, and therefore I'm going to be quite keen on this. Now, I think the market's going to turn a little bit going into Thursday, Friday, and I think we'll see a little bounce on oil, CAD, gold and Oz Thursday, Friday, but it'll be interesting to see if that's just simply profit-taking based on how things have developed. There'll be all the buyers of gold early stages of the sessions here, and that'll be on the back of the Greek elections. It'll be back on the back of the Ukraine situation, and that's going to push gold into higher prices. Now, I'm going to like that, because the higher it goes, the more I'm going to enjoy this particular gold trade. So I'm going to be watching for that top edge rejection. I'm going to be looking for the prices to go higher, into higher liquidity, for the bulls to get a little bit over aggressive and just to take advantage of that, and then take them off sell side, and we'll look to do that. Very, very interesting indeed, the little market there. So Aussie, the dollar yen under pressure this morning. The dollar yen under pressure this morning, which is as I said, fine by me. Nice gap down on the S&P as well. So that's coming off the Aussie dollar, the dollar yen under pressure. You know that would have gap down. You would have been sell side the S&P based on what was happening with dollar yen. Nothing wrong with that, guys. Nothing wrong with that at all. Okay, so we're now 50 minutes into this. As I said, next week we've got PMI as well coming out, very strong correlation. We've obviously got the FOMC, we've got UK retail sales as well, flash inflation numbers from Eurozone, and the latest unemployment information as well coming out. We've got US retail sales, and well, what else have we got? GDP. No change in policy for the US, no change in policy for the FOMC from the GDP numbers. And you know, the one thing we always ask you to do is when you look at a specific number or a specific event like an FOMC, we ask you a very simple question, and that is, what factors, if you were sitting on the FOMC, don't think about what they're going to do, what would you do on the FOMC at the moment? Would you see in the last quarter, for example, the kind of growth that would make you stand up and take note and say, I need to increase interest rates. There's no option. The inflation's out of control. You know, the job numbers are coming in incredibly strong. The home sales are going ridiculously through the roof, etc., etc. Is that happening? The answer is no. What factors could lead to a decrease in interest rates? Well, we're not going to get a decrease in interest rates in the US. Well, we don't think we're going to get a decrease in interest rates in the US. It's very unlikely. It has a probability, though. It still has a probability. But you want to say, you know, you don't want to discount it, because the people that discount these things are the guys that were buying that bottom edge cap on the Euro Swiss, or you know, and they were the ones that were upside down because they discounted any possibility that the SNB could act on this one. Now, the SNB acted because of the situation coming up in Euro, because they knew that QE was coming into play. The Swiss was obviously going to be under pressure on that cap, and they therefore knew that they didn't want to spend another absolute fortune trying to defend it. So as a scenario developing, you could have actually found your way into something like that, but you could have actually avoided certainly of getting caught by it as well. Okay, so very, very important. So what factors could lead to an FOMC increase in rates? What factors could lead to an FOMC decrease in rates? What is the most likely scenario, and how would you like to play it? That's the questions you want to ask yourself. The way you do that, look over the last quarter's data, because that's what the FOMC will be doing. Look over the last month in particular. Look at the trends. Look at inflation. Look at the wages numbers, because obviously with the low costs of commodities, the oil prices, etc., inflation ain't showing up, and it ain't going to show up anytime soon. So what they're looking at is wage inflation. Very, very important, wage inflation. So how's the wage inflation been doing? Well, the US reading of wage inflation actually has been very, very disappointing. Wage growth has almost been non-existent in the US, even with this incredible growth in the non-farm payroll numbers. You've seen some enormous numbers coming out on these. But where's the wage growth? It's not followed through, has it? It simply hasn't followed through yet. So where is that wage growth? It's not there, guys. So what are they going to be looking at? Well, simply non-farm payroll numbers and saying, well, the growth in the jobs market looks good. Absolutely, it does look good. Is it enough to increase interest rates? Probably not. And even some of the very hawkish members of the FOMC, you'll come to know these guys. You'll come to know Fisher, you'll come to know Koch-Lakota, and all the rest. Bullard, you'll know all these guys. You'll get to know them. You'll know what their ideas are. You'll get to have a feel, or at least you should have an idea. You should have a feel for what their ideas are, where they're sitting, and if they've recently changed their rhetoric, if they've recently changed their soundbite type of information, and it's important you understand that and you get an early read on that, because obviously these guys are important. These guys are what determines whether you're making a success of your trade or not. So, you know, if it's important, you've got to know it. You've got to simply know it. So in other words, what we're looking at is probably a dovish read of the FOMC. I think everybody would probably go along with that. If you don't, find a trade that makes sense to you, because we are not asking everybody to agree with us. That's the one thing we never do. You don't have to agree with a single word we say. Just make sure you've got a plan to deal with what it is you believe is going to be trading out, and get your levels right, get your price action right, get your order flow right, and then deal. It's as simple as that. So retail sales, that's the other one. So we've looked at retail sales. that obviously has a big impact on the GDP numbers. So if you look at the January 14th retail sales, for example, down 1% approximately against a forecast of 0.1. So big downward revisions as well on these numbers. So the GDP numbers leading into the FOMC numbers, etc., the combination of these things is not reading particularly well, and therefore we could find that the dollar going into the back end of this week could be under a little bit of pressure, and we might well be moving from a bearish, a bullish and bid situation to a bullish and offered situation. A bit of profit taking off of top edges. I'd love to see the euro trading around about the 110 evens at that stage, and possibly even slightly sub 110, but certainly 110. I'm going to be looking for a big rejection bounce off of that level, and a lot of profit taking at the 110 evens, and we'll be looking to get a couple of contra trades on there, possibly Thursday and Friday, depending on how price action goes. But here's the point: have the ability to change your mind, have the ability to turn on a sixpence. Never marry that short position forever and a day, and just keep trading into it on the basis it's got to go sell side, because your account will suffer as a result. Make sure you trade as you see things developing, as you see a scenario developing. Is the buy scenario euro dollar actually starting to develop? If it is, we always teach people to trade smaller size, but you can still go buy side. And when it does reach into one of our macro levels to get sell side, smash it big style, sell side only as soon as we see a read on this one. So that's us kind of at the end of that little first section. What I want to do is, as I said, there's not an awful lot to read into tomorrow. So what I want to do is take a look at something here, guys. I wanted just to look at some price action for a second here. Back on an MT4 here, and I wanted just to consider what actually the kind of read that you get off of these things. What is it you're actually reading when you start looking at, for example, very basic tape reading using an MT4, not even using volume at this stage, but very basic tape reading by way of what happens at certain prices. Now, a lot of people associate tape reading by looking at their time of sales. They see all these numbers coming through and they go, okay, I can read the tape here. I can see a lot of selling and it's being absorbed at certain prices. If that floats your boat, guys, we do that in the classroom as well. We do that in the course as well. We do a normal tape reading. We show you what absorption actually looks like, what stop runs look like, obviously on the chart. But you can do it just by understanding price action. You can do it by simply looking at it, and we'll actually go back to the euro pound on the dollar on the euro pound on the hour chart, so that we can get a better idea of how some of these things can develop. Now, what you're looking at very simply on this dollar CAD chart here is you're looking at certain reactions at certain prices. Now, a lot of people don't even know how to draw a level in properly. And it's critical that you can actually really grasp the concept of how to draw a level on your chart. So for the guys that are new coming in, I want to make sure that number one, at least if you don't join the class, you can go away knowing how to draw levels and how to start looking at interpreting price action at certain levels. Because here, we just want to take you through this Aussie dollar CAD daily chart for the time being here. Because drawing a level isn't that difficult. Everybody can do it, but it's understanding the decisions that are being made at those levels that is absolutely critical, but not just the decisions that are being made at these levels. Because next week what I'm going to be exploring is breaking down bar by every single bar analysis, whether it's on the daily, whether it's on the hour, whether it's even on the 5 minute. It gets less value as you go down into the 5 minute chart in this case. So you're looking more at a macro kind of view on this one. But you can see very clearly on a daily chart here, you can see a level that obviously has 2 points here, and you can see obviously a very strong rejection. Now, this is something that is obviously of interest. Now, what we're interested in is what does it do with closed towards the low of this bar. Now, tape reading is very simply an assessment ultimately of what happened on that bar, what happened that day. You can see that the buyers came up to a level. You can see this level was a level that was very strongly rejected here, wasn't it? Look at the price action in this one. This is a complete, if you're a candlestick aficionado, it's a complete engulfing candle, isn't it? So all we would read into that is obviously that the sell side action, the sellers came in, completely swamped all the buying in this area completely, and the selling took over. So this is a level we want to pay very, very close attention to. Very close attention to it indeed. And what we're looking for is what happens when price comes back to this level. And you can see quite clearly when price comes back to this level, we actually reject it and price closes lower, and you would have been looking very, very quickly at a sell side opportunity, at least away from this rejection. The other thing that you're going to be looking at is the fact that what happens at the bottom edge, because we need to know where this is going to go. Well, at the bottom edge, we had a balance area. Now, all the guys in the room will know paycheck liquidity, and if you look at this on a daily chart, you would have seen that there was a paycheck liquidity level right here, guys. All the guys in the room will agree with me and go, holy moly, I wish I traded dollar CAD that day. Because what this told us was a massive decision was made right here in 2013. I know we're going back a little bit here, guys, but it's not about being relevant as far as up-to-date trades. This is a classroom type session, okay? So this was a beautiful opportunity as far as paycheck liquidity was concerned. A massive decision was made here to go buy side this market here. A massive decision, not a small decision, a massive decision was made to go buy side the market here, dollar CAD, or Aussie dollar CAD that is. And price obviously comes up for this rejection up here. Now you could have had this line in here as well, and you would have seen that price clears that level, no problem at all. But this is what you would call a pass-through rejection. It completely passes through this balance area to the left here, completely passes through it. And what we're interested in is any rejection of that, these prices coming into a future day. Now you can see at the very bottom edge, you can see a very clean bottom edge here. Okay, you can see that one. And you can see when prices come back inside this value area here, what happens? Prices stall. There is absolutely no follow through. There's a very aggressive down bar right here. Very aggressive down bar. Prices start stalling. You can see this absolute no interest, no supply in this bar at all. And you can see that prices start moving away very, very aggressively. A couple of bars to get back down to retest here. Absolutely no follow through. Prices move away. And then what we call higher acceptance right here. Now, for the guys in the room, where does this higher acceptance come into play? Well, again, it's very, very simple. It happens to be right off the bottom edge here, and this frames the market for us because we now have, very simply, for the guys that have maybe done profile in the past, we now have a top edge, we've now got a POC, we've now got a bottom edge of our market. We also have a higher acceptance in the top half of our balance area. And if we've got higher acceptance, what is that telling you about the buyers? And this is one of the things we want you to think about. This is one of the things we want you to take away from this room if you decide not to join us. What does this tell you about buyers? If the buyers had a big decision here, the fact that buyers came in off the bottom edge of this value area, and now buyers are starting to buy off the bottom edge of this POC, you do not want to be sell side this market, guys. You seriously do not want to be sell side this market. You want to be buying as much as you possibly can for a top edge squeeze. The top edge is going to go, make no mistake about that. The top edge is going to go by 1 pip or by 1,000 pips. You don't know, but the top edge will give. This higher acceptance tells you that the top edge will give. And what we're looking at, not to sell the next pass back up here. We could sell this one on this rejection. We will not sell it again ever. No way would we sell this again unless price came above, came back inside value, and we got a nice strong close to the downside. So where do we go from here? Well, you can see when price goes above it, what is the decision that is made? This is the question I want you to start asking yourself as a wee freebie for you guys that are not joining us. What decision is made right here? It's quite a clear decision, isn't it? Look, higher acceptance, price goes above this level here. But what happens? What decision is made when price goes above this level? Is the decision to go back inside the value area below, or is the decision to balance above the level? Now, think about not the fact that prices are balancing above the level. Think about what is actually happening here. For prices to hold above this level, somebody somewhere has to be willing to be happy enough to buy at an elevated price. Now, the only person that can actually hold prices at this elevated level are the institutions. They're the only ones that have got the money that can actually buy and hold a level like this in this elevated position here. Otherwise, price would reject, price would come back down, and it would find one of these two levels as a level that it would deal off of again, okay? So what we need to do is when we go into an area of decision-making process, which is one of these locations here, we need to then drill down, and we know when we see one of these pin rejections here, we would drill down from this daily into an hour chart, and then from the hour down into the 5-minute chart or whatever chart you're going to deal off of, we would start dealing off of those levels, and we would start looking for opportunities to go buy side this market on this higher acceptance by the institutions. We then have to find a way into a trade somewhere in this area. So when we see this strong rejection away from this balance area here, we know that we are on the right side of the trade. We know simply we're on the right side of the trade. And this is a balance area that develops here. It's got a higher move developing quite nicely. And you can see that we obviously trade away from this particular range here. That was a really bad attempt at a line there, guys. I'll do it again. And you can see we end up in a very, very strong uptrend all the way up to the top edge here. You can see that we also get a little bit just here. Now this trend line breaks. And trend lines do actually have an importance to us. I mean, it's not a huge importance, but you get to know when to use trend lines properly. And what you're looking for is what happens when price breaks a trend line. How does price react to the dealing point when it comes back into it? And this is going to become absolutely critical for you as a successful trader going forward. So when you get this buy side trade, you can see price trades up quite nicely. A higher acceptance up here should give us higher prices. It doesn't. It breaks a trend line, and all of a sudden we now have an interest in this line right here. We now have an interest in this line right here. We also have an interest, obviously, in the line at the very top, and we probably would have some kind of a level of interest in a little POC somewhere in the middle here. So we're now going to start focusing in. Once this trend line breaks, we're going to start focusing in on what happens when price comes back up to this, any of these three lines. We don't care, because it's not an exact science. The markets happen to deal in zones and levels and locations. So when price comes up to this level here, and you can see a strong pin rejection off of this one here, guys. See this strong pin rejection off of this level here. This, guys, becomes very simply a huge opportunity, and we're going to mark that level up on our charts. Because a big decision's been made here, an absolutely critical decision has been made here. That the big boys didn't want that higher liquidity. The way they wanted that little pin rejection down at the bottom edge, they decided not to do at the top edge. And if they're therefore not deciding to do it at the top edge, there's going to be somewhere else, and it's going to be off of one of these three lines. And what you're looking for is a big bar coming away from that with a beautiful absorption pin. So what is an absorption pin? It's simply that the buyers at some stage during that day tried to drive prices back inside that value area and were unsuccessful. The sellers came out and actually closed below the open of that day, and that is tape reading, guys. That is absolute tape reading at its very, very rawest and finest. So you're reading what's happened there. Now, you can't trade off that. That's the thing. You can't trade off this. There's a lot of people would say, well, there's a beautiful close there, and you would sell it. Well, you don't know that it's going to do that until it's done that. But what it does leave behind is it leaves a footprint the size of an elephant behind in its wake, telling you that is a location you can lean against as far as sell opportunities in the future. You don't sell it as it's coming into that level, guys. You start looking for the opportunities as it develops inside that area on a smaller time frame, okay? And that's going to be critical. It's going to be critical. So what are the decisions? Look, there was sell side opportunity just on this one here. On a daily chart, that goes for approximately 300 pips. There was a sell side opportunity there. There was obviously a sell side opportunity maybe here and a sell side opportunity there. Now, each of these sell opportunities, are worth several hundred pips. I mean, just one opportunity on one situation that when you see this kind of decision being made, it decides not to go higher, it decides to go lower instead, and then you see that rejection off of one of those key levels inside of a value area. Absolutely critical that you actually pay attention to that and you start looking for that opportunity. Now, coming down to a bottom edge, you can say, okay, well, where is it going to go from here? If we go sell side, it's not too difficult actually to interpret, because if we're looking at the same kind of situation as this at the top edge, we know that there was obviously a top edge of a, sorry guys, there was obviously a top edge of this balance area was here, approximately. You can see that we're talking about this balance area here, okay? So there was a top edge there. There was obviously a POC level approximately through here. And there was obviously a bottom edge. We take all the pins off of these in most cases. There was obviously a bottom edge somewhere around about here. So we know that that value area will have some kind of response. That little we can see quite clearly as price trades down to it and then starts stalling as it comes into it. See how price trades down to it. Now remember what I said. You don't just buy a trade. You just don't buy a level just because price is coming down to it. You need to then drill down and find the opportunities. But we know that if we start seeing price drying up here, the supply drying up here, and then we see, for example, this big rejection of this lower move here in this bar right here with a higher close, we know that this area here is going to start developing into some kind of interest. So we would be able to take that very simply, project it to the side here, and have some kind of level where we wanted to start being interested in dealing. Okay, now we need to see an action at that. You know, we need to see an action, actually a reaction at that price before we start getting buy side. But guys, there was a full day and a half here, 2 days, where we actually got a beautiful reaction. First of all, we kicked off with the sell side here. It goes very aggressive sell side, and then you can see that the same kind of rolling over process happens at the same level, doesn't it? See how price starts slowing down as we come into this level, and then we get a 2-day reversal there. A 2-day reversal. Whoopie-doo. But guess what? This becomes critical because we've actually got something very, very interesting. We've got very, very good information here. Because when price rolls back across here and starts coming back into this level here, it offers up opportunities on the 5-minute chart for a thing called a squeeze. And a squeeze is one of the highest probability trades you'll ever see because it's always with the trend, it's always in the big macro direction, and it almost has, it's almost got an impeccable trade track record. And it's one of those few locations. It's one of those few locations where you have a house edge. You actually have an edge over the institutions, because you know that they have to deal if prices move in a certain direction, and that is what's going to give you a huge bang for your buck. And you end up getting a beautiful trade that ultimately comes all the way down to, surprisingly enough, some POC level in the middle here. I think you would agree that that level's quite realistic. We can see a couple of rejections off it, a couple of rejections at the top edge here off it, a couple of rejections here and a rejection off of here. So it's not as if this is a force fit of a level. We've got a bottom, a top, and a middle. We've got a bottom, a top, and a middle. Pretty much exactly the same. So when we see a very, very directional move and it stops dead. Now, obviously, if price then on the next day comes up and then it tapers off here and you'd go sell side as soon as we got down close to that bottom edge again. Well, it didn't do that. It actually moves away from this area. And it actually taps back to it. Now, in volume terms, it actually taps back to it in lower volume. And the other interesting thing you can see simply from pure price action is that the down bars actually have quite a lot of buying in them because it doesn't close at the lows of these down bars. And therefore, you are going buy side the market off of this level again. So a decision's being made right here for buy side opportunities, isn't it? A decision's being made right here for buy side because they decided not to go lower. That's the decision that's been made after the close of this bar. Now, you might not find a buy opportunity. That's fine, and if prices go all the way up to here and you've sat in the sidelines and you haven't traded, that's fine as well because you're not going to catch everything. But here's the gift that you get. You actually get a pullback right into this day. You get a pullback, and you'd have been looking inside this day for buy opportunities. Then you'd have absolutely guaranteed that you would have found 1 or 2 or 3 or 4 or possibly 10 buy opportunities to go buy side Aussie dollar against the CAD here. And price moves away back up to this top edge, back off this top edge. Now, a level that you should be looking and seeing, obviously, is this one. It's developing. You can see a level's developing. So you want to know what's going to happen if price deals outside of those levels. Okay? You really want to know what's happening if price deals outside of those levels. So when you see this very aggressive move down and price comes below this level, guess what? Your sell side only in a location probably the next day. Now, you don't go sell side this one because you don't know what's going to happen. But when that bar closes, guys, I can tell you with 100% certainty that inside this room, we would have that zone. So for that bar that marks up there, we are going to be sell side only at the very, very top of that bar, almost to the top tick of that day, I can almost guarantee you that we would be sell side because we're trading that one from the POC down. It's an inside out trade right here. It is beautiful. But how could you have started to know about this? Well, it's very, very simple, because if you actually watched what we were doing here, okay? If you watch what we were doing here with these trend lines, this one and this one, and you can find any opportunity to draw in trend lines, okay? So there's a trend line. We've seen a break, okay? We've seen a trend line break here, and we want to be watching what happens once we get a trend line break. We want to watch what happens when price comes up to the previous price points. So we're going to start watching these levels here. We're going to start watching the POC level right here. And we're going to be start watching this bottom edge. So when we see this price breaking on a very simple trend line, and we then see price then trading up, and you can see some strong rejections here, we know that obviously very similar to these rejections, this was bottom edge, but this is actually exactly the same principle right here. We know that we're going to be interested in this location as far as a sell opportunity is concerned. And you would have been able to get some sell side, not as price goes up into the level, by the way, guys, as price comes back through the level, because we don't know if it's going to keep going. And if it does keep going, we're not going to get caught on it. We're not going to be part of that stop run. But when price tells us on a smaller time frame, we go sell side only, and we get a nice move, clean move through that level. Absolutely no response off of this one. We start seeing a couple of pins here, but look at the kind of pin bars we get. Would these pin bars, would they give you complete confidence to go buy side this market? Absolutely none. Absolutely none, because if those pin bars are located right here, these little spinners are located right here, it means that there's still some serious selling coming into this this bottom edge. And if there's serious selling, guys, at this bottom edge, there's no way this price is going to go up whilst there's some serious selling. If there is supply at this price right here, there is no way this price is going to go up here until we see something else develop. So you're going to be looking inside these areas, and you're going to be going sell side. The very same idea as we go sell side in this location, and those bars, as they develop, as those bars develop, Fibonacci, as those bars develop there, we would be looking at sell side opportunities here for this continuation. Okay, so what happens? Look, see how this level keeps coming back into play. See how this level, when this level has been a decision point by the big boys, it remains, and it always will remain, a decision point until some other decision's been made at it. Okay, so when you see price coming up and making decisions again here, this is a level we want to be very, very understanding of what is happening. This here is what we call a PCA, easy kill trade. It's in the continuation direction of the overall trend. It's a very, very simple trade to put on. You're simply looking for a move back inside value to go sell side. So our sell would probably have been somewhere around about 99.5, probably somewhere around about in here. We would wait for price going above. We wouldn't fade it straight away because we don't know if it's going to keep going. We need to wait to see it coming back inside value. Worst case we know is that it's going to trade down to the bottom edge of value here. And it does trade to the bottom edge of value. It goes below and it starts establishing. Now, if you take this whole thing now to the current market, look at the decision that was made just recently. Look at the decision that was made just recently off of this chart. Can you see it? It's not too difficult to find trade opportunities when you know these key decision areas that are being made. Now, you might say, okay, well, what's the trade here? Okay, so let's take this one down a little bit. So this is the Aussie CAD daily, so let's go down into the 1 hour chart. So we've got this level in now. We're interested in sell side only this market. So we're going to be looking at the 1 hour chart. Let's see if we can find any kind of opportunities on the 1 hour chart. And an opportunity just screams at you, does it not? It's got to scream at you, because look at the size of this absorption candle right here. And price moves away. There's absolutely no way that price is ever going to deal through that top edge. There's no way price is ever going to deal through that top edge in the next rotation, the next auction market. So very simply, we know on a massive absorption candle like that, we can take that one and we can draw a line on the basis that we know that this is a sell zone. We can draw a line in this area, and we want to go sell side somewhere in this area. Okay, so we can delete this one. Let me just, so that we don't get confused. I've got a tendency to get confused which line's still in play. Okay, so we know that we want to be sell side. We can actually zoom in a little bit just here. We know we want to be, now we're not selling on this one, remember guys, because we don't know if that's how it's going to develop, because obviously this next bar here could just trade straight back up to the very, very top edge here, in which case we're going to start looking for sells right at the very top edge. But when price deals lower, we're going to be interested in selling up here. So let's take it from the hour and let's take it down into a 5-minute chart. Okay, so I'm interested in a rejection on the 5-minute chart here. Now, a rejection, very simply, is just the price action. Look for the price action to reject. Can everybody see a very strong rejection of this area here? Look, what we're looking for, very simply, is the demand to be taken out, because that's obviously telling us that the selling has overcome the demand, isn't it? Yeah. So we know that this is a macro area that we know we want to deal from. We know this is a macro area we want to deal from. We know that the demand's been taken out when price comes down here. So on a 5-minute chart, all of a sudden, I simply can zoom now into this area here and look for rejections. Okay, because we've now seen that we can't deal in this one because the demand's still in this market, isn't it? We can't deal in this one because the demand is still in the market. We can start dealing when the demand is now dried up a little bit. We can now start dealing on any pullback into this area here, because we now know that the demand's has been compromised. The demand's off the table, and therefore the worst case scenario is, if we can deal up here, the worst case scenario is we're going to get a rotation down to the bottom edge down here. Now, it might not look like a great trade, and it probably isn't a great trade, but if you can deal somewhere here down to here, well, it's a huge trade of around about 38 odd pips. It's not much, but it's not bad either, guys. So there's the trade right there. We're dealing as it comes up into this location here. We're going sell side the market, sell side the market. We've actually ending up with actually what turns out to be, if you zoom out a little bit here, it turns out to be an absolute monster trade. You see that? It turns out to be an absolute monster trade. Now look, here's one of our other levels right here. Now we know if we actually take that level and we project that level across and we're saying, okay, we're wanting to deal in any kind of rejection off of these levels. Let's just look at this next trade. So we're sell side off of this one. Let's look at the next trade. Okay, so we're going to drill into this area and we're going to look for a bar rejection. Can everybody see the rejection off that area? It's quite clear, isn't it? So we know we can't deal that rejection because we don't know that's a rejection until that bar's completed, okay? So, this isn't, forecasting the impossible here. We're actually waiting until that bar completes. We know there's the pin. We know we want to deal here. We can see quite clearly that the last demand has actually been taken off the table on it. And can you see, therefore, that the trade is right here? Can you see as prices then tap back into this location here, you're quite confident that you can deal off of that rejection off the top edge because the demand is gone. The demand's gone here. And therefore, this trade right here, it's easy enough to find a level, by the way, guys. You just take that level across. This trade right here becomes a nice sell trade, and off we go on the next leg of our journey to the downside. And when we come down to the bottom edge, we've got another level, and you can see that we've got a couple of ideas here. Now, let's just look at these ideas. Here's a bottom edge here, for example. We know as we get any kind of lower balance areas, we know this is a lower balance area here, okay? We've got a lower balance area here. You know certainly that this is how we draw the charts out here. We know that we've got a lower balance area, and we know that we want to be sell side this market. So can you see that we get a rejection off of this lower balance area? And when we get a rejection, it's kind of a touch and go, but we do actually take out the last little demand there. You can see very clearly that we could have been sell side off of this level here. Now, we've also got a new balance area, haven't we? We've got a lower balance area here. We've got a middle price right through the middle, surprisingly enough. That's why it's a middle price through this area here. And obviously the top edge is actually still this same bar right here, isn't it? The same bar, the same line right here. So when we come down here and we actually see price coming back up and we see a rejection, we know that this is a level that we can trade at. So we take that level, we've seen a rejection off of this area here, we know we can deal off that. And when price then taps back into that area, we know we can deal. We know we can deal. We've got confidence that we can deal, and off we go again here. Sell side only, coming into obviously the close and into obviously the open of today. And whether you take that deal or not is a different question. But it's still the right deal because we've seen a level, we've seen a rejection of the level, and in this case here, and then we're going to deal off that level as far as sell side. Okay, and there we go. So let's look at very quickly now. I'm kind of pushing on in time here, and I know you've been in for quite some time, I would imagine already. And let's look at something like this pound, euro-pound market on the hour chart. And it's all about drawing levels and about the reaction to price as you go through some of these levels. Can you see the big rejection of higher prices here? This is massive, massive rejection of higher prices up here. Price comes back inside value, your sell side only. Now here's the critical thing about drawing a level in. The level is where value is. So when you project those levels across, guys, you're not really you take a note of that pin rejection because you know price shouldn't go through that on the next pass. But the level you're really keen on is this level here. This level here, which was a rejection before, it was a little balance area here. This is a level you're looking for rejection. You see demand coming off here, and you're looking and you can see quite clearly the sell opportunities. Price pins into that area to go sell side this market. Now, when you see price then accepting below, we'll just carry this through to some kind of conclusion. You're looking at whether you can deal, where you can deal. You just draw these, keep drawing and interacting with your charts here. We've got lower prices. We know that the sellers are in control. We can see a bit of a rejection off the bottom edge here. We know that this is a, we know that this is a level that we would be certainly interested in. You can see how we've taken off the pins here. We've taken off the pins here. When price comes above here and comes back below and starts accepting lower here, and we are bearish this market, we can sell that. We can sell that aggressively as soon as price comes back inside this balance area, this value area. Now, you might be looking at it saying, well, that's finished business, which is absolutely fine, and you might not take the trade because the range hasn't got enough in it. But, at the end of the day, you know that we have a balance area. We know that the probability is we should trade at least down to the bottom edge of this area. And if it starts eating into the bottom edge here, guys, guess what we end up creating? It's called unfinished business. Because when we come down into that bottom edge, this is no longer buyable. And a lot of retail traders will try and come in here and buy that bottom edge, exactly the place where we start trying to sell it, because we know that the bottom edge is no longer valid. The bottom edge ain't going to hold on a lower acceptance. And I can guarantee you, almost guarantee you, that the vast majority of our traders in the room will be sell side right here. And we'll be taking advantage of the stop run for all you guys that are buy side the bottom edge at that stage. We will squeeze this market and we'll get one of our trades that we get 90+% winners on. We'll take that trade, and if it only gives us 1 pip, we'll take our 1 pip and we'll go away. If it gives us 200 pips, 300 pips, 400 pips, fantastic. But we are certainly not going to get caught on the wrong side of this one. We know not to buy the bottom edge here. We will be sell side the bottom edge, not through the bottom edge. We will not ever take a breakaway trade here. We will not be dealing here because that might just be a simple stop run fake and we'll be back inside value. But we will be selling that bottom edge. And there's obviously a load of techniques for you to learn as to how to find that trade and how to execute that trade with perfection. But we can see what happens when price then comes down below this area here. We do not get any price acceptance at all. And then when price trades back inside this value bottom edge here, look at what happens. When price trades back inside this bottom edge here, you are simply looking for buy opportunities here. You might say you've missed a humongous big move here, but on a daily chart that obviously looks like nothing. It's just a pin rejection, isn't it? It's just a pin rejection on a bottom edge of a candle. And you're looking at buy side inside this value because you're trading, probability-wise, your trading is going to be up to the top edge of value. So you see how this is actually just simply a recycling of value. You're back inside value, even Stadelmeyer, even the profile guys will confirm that if you trade back inside value, you've got an 80% probability that you're going to trade through value. So when you identify that value is now resting up here, if we drill down into the 5-minute chart, your job as a trader would be to find a buy trade somewhere in here for an opportunity to trade up to this level here. So when we come up to this level, you can see that prices go above it. And when prices go above a level, we've got a beautiful thing because something happens right there. A decision is made. Because the decision is either to hold the top edge and go higher or come back inside value. And can everybody see what the decision was up here? It was to come back inside value right here, wasn't it? So when it comes back inside value, we know what we're going to be doing here. We are going to be sell side only this market, back inside value, back in the direction of our overall picture. As soon as we come back inside value, we're going to be looking for sell opportunities out of these locations. And we're going to try and figure out what's going to happen at the bottom edge. And at the bottom edge, we have what is called a lower acceptance. We know that we are not going to be buying. We might buy it on one of these first rejections. We know that once it comes back down a second, a third time, we're actually, believe it or not, and this isn't hindsight stuff, guys, we're going to go sell side right here. Why? Because we know we're going to get all the guys that bought in this one upside down, and we're going to go for the push through this level right here. And boy, oh boy, does that work. Now look at this level. This is the level we took our decision off of. Look at what happens the next time price comes to it. You get a rejection off it, because this is the whole point. When you start understanding where critical decisions are being made on your charts by the big boys, critical decisions. Now, we've not even looked at volume yet. This is just price action. We haven't looked at order flow yet. This is just price action. We haven't looked at sentiment or fundamentals yet. This is just price action. This is one piece of a jigsaw. So when you see the validity of these levels, when you start understanding that decision-making process as price goes through these levels, bursts through, comes back inside of value levels, you're going to start getting a far, far better and cleaner understanding of what is actually unfolding in your markets. You're going to be able to read your market so that you can then trade your market. If you can't read the market up to now, and here's the biggest problem that I've seen with a lot of retail, show me some live deals. That's all they feckin' ever want. Show me some live deals. To pot with that, it's not about showing live deals, guys. It's about you being able to read what has actually happened. Too many people are trying to live on the right-hand edge without ever understanding the reading of what got you to the right-hand edge. Do you understand that? You know, if you don't know how the destination's coming about, you're never going to be able to trade on the right-hand edge. You have to get out of that mindset on the retail space of, well, what's the next trade? What's the next trade? What's the next trade? Well, what has the trading been up to now? Where have the big boys dealt up to now? Where are the big boys positioned up to now? Because if you understand that, they don't go away overnight. They're going to be there for weeks, potentially, on the very, very big picture, on the daily charts. They're going to be there for weeks. So if you can identify those locations, and then you can start drilling down into those locations on the 1 hour. And it means that you guys basically, in a lot of cases, are asking the wrong questions. What performance can you get out of this? It's nothing to do with performance. It's nothing to do with performance. It's nothing to do with how many pips you've made today or how many pips you've lost today. Because that's the wrong that Berkshire Hathaway can do 30% in a year, which is under 1 percentage point in a day. We could pick off 100, 200, 300% in one day because of the leverage that you can get in the retail space and so on. And that's with 1% risk, guys. But equally, you can also do 1 or 2%. It doesn't, so what does it matter? It doesn't make any sense, the questions a lot of the times people ask. What is sensible is, can you see that this could give you an advantage? If reading this market the way that we are going through this, if knowing that these lines make some kind of sense, because look at what then develops. Now we're coming into January here, so it's getting relevant. Look at what happens in this area here. You can see that prices, lower acceptance, lower prices, and back inside value again here. Look, see when you get lower prices, it trades back inside a value right here, isn't it? It trades back inside a value right here. And when it trades back inside value, you're looking at a trade that potentially is probably just going to rotate back up to the top edge of value, isn't it? So if you wanted a contra trade away from this area, you're going to be able to go buy side somewhere in this area here, and there's a high probability that worst case scenario you're going to get up to the top edge. Now it's only 20 pips, guys, but it's still 20 pips. Now here's a massive decision that's made right here. Look at this decision that's made right here. Because these decisions are very, very important, because when price rejects off of that, this decision is important because price rejected in this vacuum area. This is a massive vacuum area below the market. Price is rejected here. this isn't a major decision point, but it is some kind of decision that's being made here. You know you're going to get some kind of price reaction. So when you see price coming back off that level, you can go buy side. It's exactly the same up here, guys. When you see price coming back off that level, you can be looking at sell opportunities. So when you see price coming off this and holding lower and then spiking higher and spiking back inside, well, we know this is probably going to be lower business. We know that this is going to be sell side because in general terms, there's a beautiful vacuum now formed underneath the market right here. And we know that the vacuum here is probably now going to be filled. And we would expect to see a very, very strong response if we could get through this level. Now, if we come down here, we start seeing a buy response. This changes because we then start looking for buy trades. It's as simple as that. If this is just simply on the basis that we don't have a sentiment to it or an overall bias, we would start looking for buy opportunities in this area. If we got some kind of buy response the way that we did here, we could have been buy side somewhere in here for that rotation. Very strong sell response here. So within that 3-hour period here, we would have been looking for sell opportunities. We may have been really unlucky and not found any. So what? There's 1,000 opportunities every few weeks, you know what I mean? So when price comes down here, look at what happens. We said that when it comes into this vacuum, here's another decision-making process here. What is the decision when it comes down into that area? Does it reject or does it accept price? Now, I think you've already learned enough already to see quite clearly that prices are simply accepting in this area, aren't they? So when prices go above that and then reject that area above and starts coming back in here, guess what we are? Sell side only out of this area right here. Because prices have went into higher liquidity, rejected higher liquidity very, very quickly, and we're now trading into what is called unfinished business at the bottom edge here, guys. And look at what happens. Can you see how we could have so clearly on the 14th of January, we could have drilled down into almost within about 2 or 3 pips of being able to find the exact entry for that drop that then developed here, off of 77.90s down to 75.90s. It's only 200 pips. It's only 200 pips on that trade, right there. And it simply came from understanding what this was, and then finding a trade inside that. So you might say, well, would there have been a trade there? So if we're looking at that bar there, this is sometime on the 14th. Let's go along to sometime on the 14th. Okay, let me just see if we've actually got all the way through to the 14th here, guys. What is all that rubbish that's appearing? Okay, so here's sometime on the 14th of January right here, okay? So we can see prices go above it. Can you see the trade already, guys? You should be screaming at it. You should be looking at it going, holy grail, is it? Honestly. Because here's the trade right here, isn't it? You can see price going above. You're getting a higher acceptance here. So you don't have a trade here, do you? Higher acceptance, it goes above. We don't have a trade here. It comes back below. We still don't have a trade because we haven't taken out this demand, have we? Prices then go below. Prices then go below this level. Okay, so we're looking at this now and saying, okay, we've now got the same kind of idea that we drew in before. We've got a top edge. We've got another level. And we've obviously got this level right here as well. Okay, we're looking for a rejection off of that level at some stage, and you can see that this move back inside value here rejects off of this one, comes down, and we can therefore start zooming in on this area right here, and we can see this rejection here very strongly as a beautiful sell opportunity. There it is right there, guys, right there, 77, 74, 73, 72, 70. There's the sell, and that's your trade right there, and then all of a sudden, that's your move. That's your move right there. That's a beautiful trade. And if you'd taken out right at the bottom edge there, 140 pips, guys, you're unlikely to have got that, obviously. And but that's your trade right there. So if we go back up into the hour, you can see as we developed into this lower level, you can see all these decisions that are being made here, guys. Look, here's a move here. There's a rejection of lower liquidity, trades back inside value all the way through. Lower edge again, does not trade below bottom edge. It actually holds a bottom edge, and we're saying to ourselves, okay, this is similar to this, isn't it? This is similar to this, but the trade we need, once we get this lower acceptance, you can see the only level we can deal off of very accurately is this level right here. And look at what happens at that level, guys. It's an incredibly strong pin rejection, isn't it? This, by the way, was a part of our briefing. We had an option barrier. We teach you how to trade option barriers, and we knew therefore that this lower acceptance we were looking for something like this happening. The option barrier was resting, and we knew that if we got a move below this level here, we were going to be dropping. We were looking at therefore selling this market. In fact, we were looking at selling this one. We were trading from the inside out, it's called, and we were looking at if we got a lower break here, we were going to be selling it into this, and then we were sell side the market for lower prices. Now that was developed about 5 hours before it happened, guys. So we actually developed this this little drawing around about here. Okay, we developed this drawing around about here, and you can ask any of the guys in the room if that was the case, you know, so that you know that it's not just bullshit that we're talking here, that it's actually, you know, leading edge stuff. We drew this in the charts here. We traded it lower acceptance for lower prices. We traded that lower acceptance for lower prices. We drew out how the market would develop. We would expect prices either to come down to here, and a rejection would take us back up to here where we could look for sell side, or if prices traded down to here and we got this sideways movement. Now obviously we were a wee bit lower than where I drew it in, but that's fine because it was a scenario. If we got sideways movement, we would get a drop. We got sideways movement, we got a drop, okay? That's just understanding markets, guys. That's just understanding reading skills. So the key aspect, the key takeaway from that very simply for you guys is, you know, if you understand how to draw a market, the only way you're ever going to understand that is to be able to read the market up to now. And I remember somebody actually, and there was some very rude gentleman actually came into the room one time, and he said, how about doing some front edge stuff? How about doing some leading edge stuff? He hadn't even, you know, we'd been talking about the market up to now for about 15 minutes. And I was like, just, you know, beat it. You're wasting my time. You know, you only can do leading edge. You can only start dealing on the far right-hand edge if you know what that other screen tells you. Because if you don't know what deals have taken place prior to that right-hand edge, you have got zero chance. Not 10% chance, you've got nothing. There's no way you're ever going to make money on a consistent basis if you don't know every single little turn and angle that's actually taken place in the market up to now. If you don't know where the big boys dealt and why they dealt and what was the result of their dealing, you will never be consistent on the right-hand edge, guys. I'm sorry to tell you that. And that's the biggest problem, because it's too quick to say, what about the right-hand edge? What about the right? How about learning the subject first before you start asking about right-hand edge? Because this was leading edge stuff, guys. This was leading edge stuff by hours. Not by minutes, not by 5 minutes, not by 10 minutes, but by hours. We drew this in with hours in advance. You know, and the drop wasn't insignificant either, guys. That's 250 pips over the course of 2 days. 250 on something like the euro pound, for heaven's sake. That's leading edge stuff, by the way, guys. That was in the room live. Not hindsight stuff, in the room live. But the only way you can ever do that is by understanding this. The only way you'll ever do that is by understanding the rest of it. And that's why the retail space can't make money in this market, because they haven't got the fecking patience to learn the subject. You know, this is one of the top paid careers in the world. You know, if you wanted to be an airline pilot, do you think you're going to get the job if you just turn up and say, okay, well, I bought a plane, so I'm just going to take off and see how I get on? What's going to happen? You're just going to kill yourself. In worst case, you're probably going to kill some other people. You know, you've got to take it seriously. It is not something that you can put $500 in an MT4 and hope for the best. You know, that $500 is just going to go eventually. You might get lucky and you might think you're brilliant. That's the worst thing that can ever happen to you. The best thing that can happen to you is you blow that account, believe it or not. That's the best thing that can happen, because all of a sudden you start actually appreciating this as a profession. It's got some of the brightest minds in the world involved in this, and you think you can come along and just pick it up and play it. Well, start getting to grips with this concept. It's actually quite hard. You know, it's going to be something that you're going to take you a little bit of time. It's not going to be impossible, because otherwise we wouldn't be selling any course on this subject if it was impossible. But it's going to take you a little bit of time, and we know how to obviously get you through the shortcuts. We're going to take you through the shortcuts on how to get the knowledge where you can draw those lines ahead of time, knowing what's going to happen. And if you can draw the lines ahead of time, you can deal on the right-hand edge effectively. knowing where to deal, knowing how to deal, knowing the locations to deal, knowing how to take that information and make money at it, knowing how to actually pick up that little tape reading skill that suddenly gives you the price action, that suddenly gives you a level, that suddenly gives you a sentiment trade, that somehow gives you a macro level, and all of a sudden it all fits into place and say, I'm going all in on this one. This is a maximum trade for me because it's all falling into place. And then you sell it as the market's going higher into a location that you know is going to get a massive sell response. And you know it's going to get a massive sell response because we've just shown you a couple of examples there of the kind of massive selling response that you've seen coming away from the market. Now look, might say, well, what about that last price action? Well, look at the massive sell response we had in this area here. Let's zoom in a little bit and let's look at that last piece of price action. Because look at this massive sell response off this lower acceptance here. And you might say, well, that's huge absorption. Yeah, but we haven't dealt yet. We're not dealing here. We need to see what happens with that decision. What is the actual decision? Price actually trades lower. Therefore, this bar, not this pin rejection, but this bar here beside the pin rejection is absolutely critical to us. So if that's critical to us because we know how the institutions deal, why do we know that? Because we trade with the institutions. Well, that level is going to be critical. And therefore, if I can see that level is critical, and I can then drill down into the 1 minute chart or the 5 minute chart, and I can see I'm looking to deal, and I can see a little pocket of liquidity resting just above here, so I'm interested in dealing anywhere in this blue box on a rejection on a 5 minute chart. So I need to see a rejection on a 5 minute chart first, okay? So I'm going to drill down into my 5 minute chart, and I'm going to be looking inside this little blue box here, and I'm going to be looking. Let me just get my bearings again. I've just lost my bearings here, guys. Okay, so this is the 21st. This is a rejection on the 21st of January. Okay, I'm way past where I needed to be. I needed to go back a little bit. Here's the 21st. I'm looking at my 5 minute chart here, and I'm looking for a rejection in this area. We can see the massive price coming up. Now, here's the problem. You haven't actually got a very clean rejection on this one. You haven't actually got a very clean rejection. And this is a real pity because obviously we're looking at this massive volume coming into this and no follow through. Now when you actually start understanding volume, this actually would be your trigger because you would actually be selling as soon as you see that volume, no continuation, you would have been sell side somewhere here. Okay, but that's, we're not talking about volume here. I'm just looking at price action. It would have been very difficult to have got you into an effective trade in that location right there. Now, there is a trade later on, however, that you could have got because we've seen lower value here and we would have been looking at the sell opportunities actually in these areas here to go sell side the market, but that's a slightly different entry technique. There is no clean rejection on this one, but this lower acceptance here tells us we want to be sell side. We need to find a way into the sell side with desperate measures here. And there's been a couple of opportunities to get sell side. There was a sell opportunity in this one coming back inside value. There was a couple of rejections here back inside value for sells. And you can see them over and over again. Once you understand this idea of trading back inside value off a rejection of a level, it suddenly makes some kind of perfect sense. And this is going to be important for you. It really is going to be important for you because when you see rejection of areas, what else happened here? Because one of the things that you would have been drawing in here would have been a trend line. And you can see when the trend line breaks, what happens when price comes above this area? It comes back inside it. And when it taps back into this area again, when it comes down here, when it comes up above, comes back down, let's just draw it again. Let's draw it this one. What happens when price comes back inside this area? When the trend line is broken and price comes back up to that area, it's rejection. So when you start adding all these other pieces of the jigsaw together, the one thing I heard Jason talking about was a jigsaw. It is a jigsaw. It's a load of pieces. And unfortunately, unless you know the macro picture, the fundamental picture, unless you know the overall bias of the market, unless you know where the liquidity levels that the institutions are going to deal at, you will not know what lines are relevant and what lines aren't relevant. You'll try and deal off of all sorts of lines that don't have any relevance, and you're going to get unstuck. And that's the whole point of this course, is to teach the relevance, teach the context, teach the why of the various other aspects to this. So for the guys that aren't joining us, I hope you've at least found something that you can take away and start looking at your charts in a slightly more intelligent way. Start really concentrating on that directional motivation of the market. Stop trying to fade that bottom edge and start looking at the market in an institutional way a little bit. For the guys that decide that this is something that they really want to take forward, it's, you know, we really do train every single day in the current marketplace. None of the stuff we do in training is going to be historical. It's always in the current developing market. We always use the current market for our training purposes as we go through the marketplace, so you can put your analysis on top of what we're saying and see where it starts making some kind of sense. So guys, that's us just about 2 hours. I'm sorry I went way over time here, but I wanted to get a little class session. You guys have given us your time. I wanted to see if you could get away with some information that might make some sense, as I said, if you didn't join us. I wish you all the very, very best with your training. I hope you've found something that is going to make some profits in the future, and be delighted to have you. And for the guys that do join us, I'm looking forward to any time you want to come into that room and get started. Let's get started here, guys. We've got a lot of business to be done this week. We've got a lot of business, a lot of classroom sessions that we want to get through. We're going to take this bar by bar. We want to start dissecting these decision-making processes, bar by bar, understanding the volume, the order flow, the price action, and really getting to grips with what's going on inside the institution's heads, because there's some absolute fortunes to be made this year. Absolute ginormous fortunes to be made this year. So I hope to see you on the other side, guys, if you decide to join us. I'm looking forward to that. For the guys that are with us already, I will see you guys in the morning. So that's all for me. I'm shattered at the moment, so I'm going to finish up with that, and I'll kick on. All right, guys. Cheers for now.